Hey Rob, welcome to the Fiduciary U Podcast. I gotta say, we've been trying to schedule this for a while. We've had numerous conversations, and I think this is probably the podcast like I've been most excited to do over the past several months. So I'm glad you're here.
I'm happy to be here as well. I've been looking forward to it too. And unfortunately, it's like every time we get on the phone to talk about doing this, we end up chatting about the things we should be on the podcast for like an hour. So
100%.
We're wasting all our time. This is definitely more efficient.
That's right. Well, you and I go back a number of years, back to your days at Questus and my days at Greenspring back in the day.
Yep.
When you were on kind of the fintech side, and then you were at Wise Rhino for a while, and now we're at Marshberry. So for people who maybe don't know who Marshberry is, hopefully they do, but if they don't, why don't you give just kind of a little commercial about who Marshberry is and what you do, and just kind of your background and how you got there.
Yeah, sure. So Marshberry as a company is a 41, I believe, year old company. So we've been around for a bit of time. Started purely as management consulting. We really have got two sides to our business, right? Think of it as growing and being intentional and growing the value of businesses, right? Operating more efficiently, thinking about enterprise value, hiring correctly, making sure your business is built in a way that it can actually scale, perpetuate, and continue growing. And then kind of the realization side, which is our investment bank, which is, at any point in a business's life, especially if you're a fast growing business, you may need some capital, or you may need to sell your business. You want to bring on kind of a minority partner. That's kind of the investment banking side. So we started as purely management consulting, and then about 25 years ago, got into the transaction advisory or investment banking side, mainly because we had great clients, and we ended up having to send them down the street and watching them sell their business with someone else. And we said, well, we know these businesses really well. We've helped them grow. We've helped them be successful on their own, and it'd be great to kind of be that full life cycle firm where we can help them from where they are today to some event, if it comes years and years down the road. But like the premise being, we like to help businesses, build in a way that they never have to sell, right? They never actually have to do anything. And the way I term that is, it's leverage. You're creating leverage for yourself. And, so if you ever get to a point where you actually have to do something, like you're well structured to do it, and you have the leverage to command a premium multiple and find the right partner for you, because in our opinion, fit drives value. As far as myself, I mean, I'm not quite the athlete that Josh Itzo once was, but I got here kind of I backed my way in, if you will, to investment banking. So professionally, I started in fintech. Well, technically I started in a banking program and then moved into fintech from that. And was working at Questus for a while, and kind of wore a number of hats there. But, my real entree, I guess, into what I'm doing now is I started consulting with a lot of our large clients to try and figure out like where the platform is working. And for those that aren't necessarily aware, obviously there's a lot of talk about convergence, and sometimes that's the EB and P&C side with retirement consulting or wealth management. When I was there, it was more about dealing with participants, and that certainly has not changed. That still continues today with, I think it's almost 5 years ago, Empower bought Personal Capital. But nonetheless, I was working with a lot of our largest clients on trying to figure out how do they deploy our technology platform alongside their people, their service model, to try and to take their vision for how they wanted to serve the participant channel, whether that's purely, hey, we need a more scalable way of dealing with the masses, to we know there's a gold mine in there and we want to do it the right way, but we also want to be in place to whether it's capturing rollovers or whether it's like actually managing sometimes significant amounts of assets out of the participant channel and those relationships. So that's what I consulted on. Everyone kind of had a different vision. So I was pretty lucky. I got to see groups like PwC and Lincoln Financial and Hub and One Digital and Lockton. So in some of the largest independent firms. So I got a nice crash course both in consulting, and also I guess I was maybe a little ahead of even where we are today in the wellness participant advice, crossover business world. From that, I was, I suppose, lucky enough to meet a lot of great people that end up leading a lot of those businesses now, either the parent businesses, or the organizations that ended up selling. And so that's kind of how I backed my way into this. Just, I guess, being a consultant that got to understand the businesses by working within them, and then also having a proclivity. Like, my dad's an accountant, and when I was growing up, he ran fantasy hockey leagues. When I was like 5 and 6 years old. And so I was like the guy behind the scenes every weekend, with the sheets of stats in front of me, just dealing in Excel. So I really like Excel, and I really like financials. So I guess I just melded those and have gotten into.
So when you were playing professional hockey, did your dad ever draft you onto one of his teams?
No, he's too smart for that. He's too smart for that. I don't think anyone ever did. I think I don't know. I was like the throwaway,
That's funny. Well,
so, yeah.
Everybody's got to fill.
Yeah, you and I have that. Well, I wouldn't say you and I have that in common, because I don't want to put that on you, but I can definitely tell you that there were some games where I played, and I know that the fans showed up and said, "Why did I spend $60 on this game?" So
there's my kids. Just a quick little aside. 1 year in the minor leagues, we're warming up before the game, and they're like 8,000 fans. House was packed, and they're like, the beer bat. My kids love this story, but they're like, the beer batter of the game is Josh Itzo, like the opposing. And I was like, what the heck is the beer batter of the game? They're like, for every time the beer batter strikes out, beers are half price for the remainder of the inning. And I wasn't a guy who struck out much. Well, sure enough, I get up my first at bat.
Good.
I punch out. Place goes crazy. Everybody's all fired up. I'm like, whatever. I walk back to the dugout. Second at bat, I punch out again. Place is like, goes bananas. And I'm like, I go up my third at bat. I'd never struck out 3 times in a game. And literally, people are chanting my name. I strike out for a third time. I could have run for mayor of that town. And then my fourth at bat, literally everybody's on their feet, stomping, calling, chanting my name. Not because I was any good, because I sucked that night. And I get down 0-2, and I'm like, there's no way I'm striking out 4 times in a game. I hit like a weak fly ball to left field and felt like I hit a home run personally, and just got booed to death. But I will say, the rest of the year when we went back and played there, like, I was the most popular opposing player, because I did my job as the beer batter.
Right, with that many strikeouts, the fans were probably still drunk.
Oh, they probably were. There's probably that was 25 years ago. There's probably a 25-year-old rolling around Lake Elsinore, California right now. That was conceived the night I was the beer batter.
I think there's probably a Schlichter lawsuit in the works, for some sort of like delayed liver damage.
That's probably true. That's probably true. Well, people don't want to hear about our long ago exploits.
No.
But it is interesting, like the seat that you guys get to sit in now, and then we had talked a little bit during prep, but kind of seeing like the natural progression with a lot of investment banking firms. I mean, it seems like where you guys lead is really the management consulting side, and that the investment banking is, more of where most investment banking firms in our space, they kind of come in, once somebody's ready to sell, and then take them out to market. What's interesting about, and maybe talk about some of the types of consulting projects and engagements and services you guys offer. What's interesting is that you actually get involved earlier on to help firms actually implement strategies to maximize value. And then once they're ready to do that, if that's the case, who would be in a better position but you guys, who help them engineer that growth, take them out to market?
I think you hit the nail on the head. And I think I can certainly expand on kind of what we do or some of the types of projects. But I think the at its core is like, there are a lot of really good businesses out there, but oftentimes as a business owner and entrepreneur, because we're dealing with, $2 million to $200 million firms, and you see the businesses get bigger, but the problems often are very similar, just at a different scale. And, as an entrepreneur, you probably are, and I guess I'm speaking to one right now, so you probably get it. Like, oftentimes you run so hard to build your business, you forget to like pull your head out of the clouds and start looking at it and saying, why is it built this way? Or, like, what do I do next? I never really thought about how I was going to get here, whether that's, I didn't see myself having a $2 million business. I didn't see myself having a $20 million business. And so for businesses that want to be intentional, that's where we play, right? Which is, we'll help you wherever you are, as long as you're committed to actually improving your organization, or at least understanding where it is. And then, at the end of the day, every business, it's the old saying of like, you're either going to leave your business standing up or laying down. And where I like to think that I help folks is I give them the ability to choose, which of those they want and what that looks like when they decide to leave.
So really,
that affects
optionality is what it sounds
exactly.
like.
It's optionality. It's optionality because it affects more than, it's their legacy. Oftentimes, it's a lot of these firms are, 2 to 5 partners. Oftentimes they're founders. It's very hard to perpetuate them. But it ends up affecting, not just them, but their employees, their clients, and their families oftentimes, because then, you don't want that getting caught up in some sort of estate battle. So it's really about creating optionality and helping firms grow. Even if they want to stay independent forever, that's perfectly fine with us. We're a big enough firm, we've got 240 people now and kind of operate both on this side of the pond and over in Europe, especially in London when it comes to financial services, UK. So there's not a deal out there that is going to make or break our year. So we don't have to force anyone. We believe in relationships. We believe in doing the right thing for our clients. And if they want to stay independent forever, we'll help them figure out the roadmap to get there.
How realistic, seeing and looking at a lot of firms, like how realistic is it when you look? Are there many firms? Because you hear from the industry, right? It's all, there's going to be a few big kind of players and then maybe kind of a second tier. But if you want to kind of own and operate your own shop, like you're done. Like it's not going to happen. Like
I don't know.
I don't agree with that personally, but like what do you see?
No, I don't either. And I think it's like if I was talking my own book, I'd probably say, everyone, the sky is falling. But to be honest, I think there's always room for a niche player. I think it's just when you're in the presence of large organizations that are slowly, look, you could talk to 10 people out in the industry, 5 that have sold and 5 that haven't, and they might have different opinions. So there's no real consensus. But at the end of the day, like if you look at other industries that have gone through similar, and it's very natural for consolidation to happen in industries, it just becomes harder to accidentally achieve success. And so if you're, over time, it will continue to become harder. So you're always going to be able to have smaller independent businesses that have a niche. It's just, there are going to be certain things that get competed away and you have to be aware of it and you have to operate a little more, intentionally. So I think there's always room for it. To get there, you got to grow, because I think, oftentimes people think, well, it's just like sell a client, service a client, and that there's truth in that to some extent, but you also have your own business to run that supports that, and the apparatus includes people and technology and those things. To compete, those costs increase. You want to be able to give your people, a chance to actually improve their own lives and kind of advance, and especially if you get the right people. And that requires growth. And so, we get into organic growth,
and I think that's the key there, organic growth. And for most firms, I would just say like, inorganic growth through M&A. I think if you talk
Yep.
to most firms, they say they want to be an acquirer. I think the challenge with that is a couple-fold. One, it's really expensive to be an acquirer at scale. So if you're going to do it, you probably have to have a capital partner, which means you actually don't kind of remain independent and kind of control your destiny, I would say.
Yeah.
And so the organic growth that's what gives you the optionality.
That's
and organic growth is like it's hard. It is hard to it's simple, but it's not easy, to be able to grow. And
we got to dig in on that one. I would say on the inorganic, I always say that the business you have today is your foundation, and inorganic growth is going to layer kind of bricks on top of your foundation. And if you don't have a real solid foundation, it's going to crack. It's going to crack it. And so growth
as you stack more bricks.
Exactly. And so to me, there's a couple things that go into that foundation, and really it's about having a long-term plan too. You got to know what you're building, right? I mean, you and I could go out tomorrow and say, hey, let's just buy a bunch of businesses and glob them together. We don't really have a strategy. We just know that they need to manage money, and that's kind of it. We could amass, a collection, but it's not going to be a really integrated, machine. It's going to be just a collection of parts that don't really work together.
You don't have a unified firm at that point.
Right. Exactly. And that's actually one of the things that, if we get to talking about value in the market, like the value of the firms that have the greatest value are the ones that integrate, and bring things together and operate as a kind of a unified firm. So, it's probably good color to apply to anything. But on the inorganic side, like a couple of things that you hit on that I agree with. One is it can be expensive, and even if you're not, like, let's just say it's Itzo.co, and you're just trying to acquire a business a year or do a merger. It's still expensive because if you don't have outside capital, I mean, you could argue it's more expensive if you don't have outside capital because you're using equity. Right. And so equity is going to be significantly more valuable than debt. And it's a lot harder to access like true debt facilities to create leverage on your own. So yes, it can be very expensive. It also can be very expensive, like when you're trying to figure out growth. Like growth is a function of consistency. It's also a function of like the time invested. And you're a CEO and you've worked in high growth firms. It's a lot to keep the focus on things and allow your business to continue to grow organically. When you flip it over, like someone's got to focus on inorganic.
Right.
And if you're doing it right, you have to really focus on it because you want to know what you want to integrate and you want to know what type of target you're looking for, and you got to find them and you got to vet them, and so it's a lot harder. And the other expense side on that is the cost of a bad acquisition, whether it's the person, whether it's the structure, whatever it is, like it is very expensive to unwind a bad deal. Yeah. And the damage, the uncalculable damage is like, what can it do to your culture if you pick the wrong person or the wrong firm, especially if you're a smaller organization. If you're $100 billion firm, and I'm sure some of the, my friends that are out there on like the corp dev side with a lot of these large firms or the CEOs are going to disagree a little bit, and they feel the impact, but you're going to feel it a lot less if you're a $100 billion firm acquiring than you are if you're a, $500 million or $1 billion firm.
Well, I mean, I even look back to my Morgan Stanley days when I started, there were like 10 or 15% of us that started in the same cohort.
Certainly.
Got through to the end of our training program. But Morgan Stanley had the resources where they could write off, yep. I think I had 100 people who started in my cohort, and after like 18 months, I think there were literally only like 12 to 15 of us left.
It's like intentional breakage.
100%. Yeah. But in a small firm, I mean, we dealt with this.
Can't afford it.
you can't afford it, because there's not only,
Yeah.
and I think the point you make as well, and this is just, again, I think you can find deals. We did it. I mean, we at the time weren't doing, big deals at scale, but being able to
Yeah.
find kind of advisors to tuck in and whatnot. But it was very time consuming, and there was a lot of work that went into it. And I would just say this: if you're a firm that's thinking about doing M&A, it's not to say that you couldn't, but I think what Rob mentioned is so important. You got to realize that the big players. So if you look at, a Cap Trust, or you look at a Hub, or you look at a One Digital, or, all the kind of aggregators, like, they literally have dedicated deal teams that are out there. So the idea of thinking, it would be like, it would,
Well, it's like you're putting an athlete at QB. They might be all right.
That's right. I was going to say,
it's
playing roller hockey with your buddies on Thursday nights and drinking beer, and then you're going to go play like the Washington Capitals.
Yeah.
Like,
you're
probably going to get smoked.
It's a different function, and it just, if as you mature in that, each organization figures out how they like structuring deals. Right. They know what they like the partners to look like. They've got their model built out internally, because every acquirer is they're running their own models behind the scenes, because they're looking at, like, what's the return on this investment. I mean, they're very methodical in it. They're very good at what they do.
Yeah.
And it's a lot harder to do that on your first try.
Yeah. How do you think the aggregators, it's interesting. My personal opinion is that over the next 3 to 5 years, there's been a lot of aggregation. You've got a lot of these roll-ups, especially in the retirement space. You've got a lot of these firms now. And now the move's got to be towards integration, which is a lot harder than, like,
no question,
acquiring. Like, now you got to get everybody. Like, where would you say the industry is in terms of, like, post-acquisition, really getting teams kind of, like, integrated, singing from the same hymnal?
It depends. It depends. I guess we could answer that in two ways: is on the retirement side, on the wealth side. It's a space. Calling it, like, broader financial services, which would include, like, wealth management, retirement consulting. In my opinion, from my firm's opinion, they'd probably include the insurance distribution side of it too. But when you think about consolidating industries, I agree. We're in that phase, 2, phase 3 of 4, where you actually have to integrate, and that's going to kind of dictate the winners. Every acquirer is a little bit different, and not every different business that is acquiring has as well established a platform as the next. And so for some, they're getting into the game with 70% of it built. There's someone else that's getting in that has 100% of it built, and there's someone else getting in that's 30% built. So it's everyone's at a little bit of a different place when it comes to integration, because if you are 70 or 100% built, when you're going through and you're recruiting all the different businesses that you want to acquire, or you want to bring in or partner with, or however you want to term it, because they really are partnerships. They're not like, these aren't exit plans. It's not like sell your business and leave. They're looking for partners that can grow. But
so more of a buy-in than a buyout mentality.
Yeah, exactly. I mean, if you're, everyone hears about all these multiples, not to jump around, but everyone hears about all these multiples, and a lot of them are true. I mean, there's certainly, we could dig into, like, it's about what's multiplied, not necessarily the multiple, but the multiples are true. But these are all multiples that are being applied to businesses that have 3 to 7 years runway from the main partners at the very least. So these aren't someone looking to retire and hand their book over to someone and they're getting a, you name multiple. Like, it's a significantly lower value of a business and different deal structure if it's a true exit. But nonetheless, each acquirer, like the more established acquirers that have a more well-formulated platform, it's a part of their approach to talk to all the advisors that they could potentially bring under into the fold. And right from the start, they're talking about integrating into their systems and how that allows them to be more efficient or serve their clients, better, or create a better, balance of their life so that they can go out and find more business, whatever it may be, serve their best and highest purpose. So it's, for those that have a well-established platform, like there's not a question that you're integrating right from the start. So for those organizations, they're pretty darn well integrated right now. Now there's always some time, like, I've heard it from many before, which is just because you're joining our organization doesn't mean that your clients, and this is more wealth management focused, doesn't mean your clients should have a tax event because we're changing how their money's managed. So there's always a transition on certain things, from the old way of doing it to the new way if they're making a change. But those organizations are pretty well integrated. There are others that may not have had a fully formulated platform, or they may be of the mind, and there are some examples on the insurance side too, which, insurance is probably about 10 years ahead as far as consolidation goes. So it's a good industry to look at and try and figure out what's coming.
Kind of a bellwether of
exactly. It's exactly how I describe it. It's a bellwether, exactly. And there were firms on that side of the world that did the, hey, acquire, come join us, keep your name and be an whatever company over time, switch it over. You don't necessarily have to join our technology up front. You join certain things, you don't join other things. And the market hasn't valued those businesses as well as highly as those that are, more integrated. So look, there are plenty of acquirers out there that have a lot of work to do and a lot of wood to chop. And that's not going to be necessarily easy. And I don't necessarily envy them, but who knows? I mean, the proof will be in the pudding. It's exactly why, if you look at the Harvard Business Review, stages of consolidating industries, it's why certain firms fall off in phase 3 and you have a large, amount of market share in phase 4 for the top, 3 or 4 players. So, ultimately that's going to be what drives success. I think if they can get through the first, my hot take, if you will, is if I'm an acquirer and I'm dealing, and you have to remember, those that have sold, they built successful businesses not by being company men, like they are entrepreneurs,
right?
Guys and gals who built businesses by being entrepreneurs and being flexible and doing things their way. So this is not like the most natural switch for many. But if you can get past that first, I could see it being a lot more efficient to run. You can bring your servicing advisors or second gen in that know how to do it your way. So I could see it being really successful for those that actually can make it past this first gen, can integrate well enough that they have a true operating platform. And then, it's off to the races. But there'll be breakage in those scenarios too. I think we've probably already seen it. And, we know a lot of the same people. So you're probably hearing things like I am. So,
yeah, it is an interesting, I mean, I think it and again, because I think we're still kind of like early on, it is an interesting, you have these entrepreneurs and, in some ways I feel like, I was, I hesitate to say victim, but affected by this as well, it's really hard as a founder to build and run a successful RIA. And it's a ton of work.
Yeah.
And I think there's a lot of burnout. And I think a lot of founders at times, they see valuations and they're burned out. And they're like, oh, this can be somebody else's problem.
Yeah.
And they sell and the money's nice at first. But then, like, once they kind of like get through the burnout and they kind of like recover a little bit, it's kind of like this feeling of like, oh my gosh, like, what did I do? Like, I thought my issue was that I was like, I wanted to sell my business. I was just really burned out. And I mean, I have heard through the grapevine, and I don't even know what a ratio would be. There's some folks who've sold who've been like, hey, this was like the best thing. Love it.
Yep.
Great. But I have heard from not a small percentage or number of people that I talk to. Number one, there's always going to be trade-offs. And I think if you're going to be selling, you're thinking to sell, like, that's just the thing to understand is there's going to be trade-offs.
Yep.
You don't kind of get your cake and eat it too. And it's really not going to be your business because you're going to get paid a lot of money. And so like, you have to know what those trade-offs are going in. But I do think there's a lot of folks that have this feeling of like, I think there's going to be some seller's
There's
remorse that's
yeah,
out there when they
there's
realize
no
like now
nirvana.
I can't
Yeah,
hire the way I want to, or I want to do this and I can't. It's not really my business anymore, and I got to get
yeah,
approval, and I can't. Like it can be frustrating if you're an entrepreneur and you're used to being able to make your own decisions.
yeah. I don't know anyone. I can't think of a single person in my life that would say that the business that they either own or work in is nirvana.
Right.
So there's no
Right.
reason to ascribe that nirvana exists within a large acquirer. Every organization is going to have things that they're working through, trying to get to their nirvana, and they'll never get there. So yeah, it's a fallacy. I think you also touched, a lot of the clients we have, they sell because like as a business, and you can speak to this firsthand too, you have these different growth and complexity walls that you hit along the way on the way of growth. It's a business cycle, right? You hit a wall and then the business cycle starts again, then you hit another wall and business cycle as you go up. And there's this confluence of a couple things, which is on average, well, I guess you could argue that everyone's getting older, but the average RIA owner, whether it's retirement consulting focused or wealth management focused, they're getting a little older by and large across the industry. And when you get to that next growth or complexity wall, the way you get over it is investment. Again, that's time, that's capital. And there's no guarantee that just because you're investing that you actually make it over and get somewhere else. So if I'm looking at my business and, a lot of businesses are, pass-through entities or S corps or whatever. So you're looking at distributions, and if I'm a partner and I've put 25 years into the business and I know that I want to work another, let's call it 10 years or 15 years, whatever it may be, maybe it's 10. If I'm at that next wall and I say, okay, what do I need to do to get from here to there, and then what do I want my life to be like when I get there, knowing that there's another wall ahead of that. And you say, well, I'm probably going to have to cut my distribution by 25%, 50%.
Yeah, easily.
For the next, potentially 4 years.
Yeah.
In the hopes that we can take this business, get it over the hump, make the right investments, hire the right people, and get to the point where my favorite phrase of, you can have either a whole grape or a large slice of watermelon. What would you rather have? Right. But can you get to that larger slice of watermelon? You don't know. You might not get there.
Yeah.
You might make, again, like going back to our conversation around acquisitions, like you're a small business, one bad hire can sink you for a couple of years.
Yeah.
So you just don't know.
There's the energy piece as well. Just as you get, I mean, I'm dealing with this right now. Like as you get older,
you got too much energy, right?
Yeah, I need to find some new energy. But you get, it's easy to. It just takes a lot of work. I love that idea of these walls that you're talking about, and the walls get bigger. They get more challenging, more complex. If you're hitting new walls, you've probably gotten the business you've matured your business.
Definitely.
But it's going to take a lot of time. It's going to take a lot of money, and it's going to take a lot of energy to kind of get over.
Yeah.
To get over
and you have to change how you work, right? We said what got you here won't get you there.
That's right.
Those walls are typically the points where you have to reevaluate and say, okay, how do we have to change to get to that next thing, right? The other adding growth into that equation, right? Because you can't get over a wall without growth. You can't get to the next wall without growth. Our business is one where the advisors, the producers are, there's a lifestyle wall for every producer, right? Where they're going to hit a point where they say, okay, I'm making enough.
Right.
I'm making enough. I don't have to be on a flight every week. I don't have to, be whining and dining people I don't like. So there's a natural constraint to growth with the human capital you have in your business today. So you're always going to need to be cultivating the next generation of folks that can produce. And that's not easy because that's all it's you have to make the decision to always have that kind of a margin drain on your business as you try out, the one or the two or the three people that you're trying to train up, to take the mantle over time.
We used to call it feeding the beast. Like,
yeah, it's
once
exactly.
you make the commitment to growth, like, you got to keep feeding.
Well, think about your time at Morgan Stanley, right? They recognize that.
Yeah.
I mean, we make light of it. We say how many people get put into the meat grinder and how many actually make it out. But it's the same function, which is if you want to create a fairly scalable way to bring on the next generation of producers that are going to allow your business to keep growing and keep growing and keep growing, it's going to be some trial and error, and there's probably a systematic way of doing it. You just got to commit to it.
Right. Well, and you have to be willing. One of the phrases we used to use is we had to maintain a break and rebuild mentality. That idea. We used to use that internally, what you said, like what got us to where we are isn't going to get us to where we want to go. And we have to have what I would call the courage, the desire, and the intent to break and rebuild. And so let's pivot into, a lot of these firms and a lot of firms, I would say a lot of firms are really awesome lifestyle practices, super profitable. They're usually built around, a small handful of advisors who are kind of like the rainmakers, and they build staff around them. And it's a great income play, and it's a great lifestyle play. And the flip side of that is actually trying to build an enterprise that is going to be more valuable. I always used to say, like, you can either be super profitable or you can grow really fast, but you can't really do both. It's hard to do both. What do you see, like, what's the challenge, or what's maybe the framework or the blueprint for firms that do want to grow? They want to remain independent, or maybe they want to grow to a point they're not ready to sell yet, but they want to implement a growth strategy, and maybe they have the one or the two rainmakers and a bunch of staff. Like, what do they need to do to really embed growth and DNA into their DNA and actually be able to execute on it?
Well, I think and some of this is just going to be opinion, because I don't really know that there's a perfect blueprint out there. It's kind of like going back to sports, which is the best players. Yeah, they're really good at kind of around the edges. That's where those elite guys are elite. Yeah, guys and gals. But they're masters of the basics. And so I think it's just a matter of like, okay, so let's define the basics. Well, the basics are run the business like a business. And not saying, hey, you run a successful business, you can't like run your wine through it, or your boat, or whatever you're doing. Like, I'm not saying that. I'm certainly not here.
Is that tax advice? Are you giving tax advice right now, Rob?
I'm not allowed to give. I must say that I can't give tax advice. Okay. But I'm not saying like but you got to manage it in a way that like you can look at it and be able to say, oh, okay, we need to make a tweak here or a tweak there, and actually use benchmarks and run the financial side of the business, so at least you can interpret it like a business. The second, and my our president, so we have a CEO forum we do it in the insurance space with P&C and EB groups, but we also do it for wealth management and retirement consulting firms, and we get together a couple times a year. But in the last one we had, my president, Phil Trem, actually made an interesting point that I'd never heard from anyone, but we talked about like, where is value derived from firms? And it's derived from the relationships that, the advisors and the staff have with the clients, right? And then we said, well, what's the biggest challenge in our industry? Well, it's finding good people, to grow these businesses. So the argument could be made in the sense of this conversation. The fundamentals are really, you're an HR business, but how many scaled organizations have someone that's actually running HR or doing recruiting and trying to find those next people? Like, pretty much no one. Like, who does the recruiting? It's probably the founder or the CEO. You have an outside recruiter. Like, it's funny because these are HR businesses, and very few folks actually pay that much attention to HR.
Right.
So So that's maybe another fundamental. And then the third is just the master of the basics. Like we were chatting before we got on, on the podcast, and, it's what are the most basic elements of organic growth? And it's probably referrals, right? Across all lines, whether it's retirement consulting or wealth management, it's referral-based business. And, how many, if you run into a CEO on the street, and this is odd, chances of you running into a smaller mid-market, CEO of a wealth management retirement consulting firm on the street is probably not that high, but
unless you join a country club and play golf.
So, yeah, exactly.
90% of people are financial advisors.
Good point. The practice green. If you run into them on the practice green, how many of them could actually articulate like who their client is and why they find value in them and where they find more of them? It's probably under 20%. It's probably less than 10% in my experience. So, that's the bare bones. Like, forget about setting up a cold calling engine or optimizing your digital marketing or, doing paid leads or finding that your next $2 million client out of the participant base. Like, how about just understand why your clients like you? Understand how you got them, why you won, ask them why they actually like you, where are they finding value, and then expanding on that. That influences the rest of your strategy. So that's, to me, that's the basic that everyone should get to, especially once you hit a point of scale. It's easier to look at it in the wealth management side. It's like once you hit say 100 million in assets as a firm or 200 million in assets as a firm, you should probably take a really close look at your client base and understand who they are and start to figure out who you want to work with going forward. And like you've said in the past, and, both to me and on podcasts, like start to niche out a little bit.
Yeah.
It's not necessarily as limiting. Like I know I've heard people say, well, I don't want to niche because I'm going to turn away all these clients. And it's like, well, you're not really growing right now. So are you really turning away? Like, who are you turning away?
No, I do think that's a great point. I mean, I think the successful advisor of the future is niche focused. And I think successful firms, especially if they want to remain independent, they're going to have to grow, and it's going to have to be organic. And the way to do that is, I think having collections of advisors, let's say, or teams or whatnot, that are focused on niche markets. And part of the benefit of knowing a niche is, like, you're going to, from like a discovery standpoint, like it's the difference of, I mean, I got a meniscus issue right now. I got a knee issue as I'm getting older, and I could go see my general practitioner, and he could probably check me out, and he's like, "Yeah, you got like a sore knee." Meanwhile, like my buddy who I texted this morning is literally an orthopedic surgeon who works on knees. Like when I need my knee fixed, like I'm going to that guy.
Yep.
Because it's all that he does. He publishes, he speaks, he does research. He like that's what he does.
Yeah.
If I got a bad cough, or the flu, like I'm not going to see him. And so I think that specialization, you can just really begin. That's the key. The key to escaping competition is differentiation. Certain death is if you're commoditized, if you can't differentiate. And I think that's what a lot of advisors have an issue with. You see it on the retirement side. Everybody says the same thing now. You see it on the wealth side. Like if you ask, you look at 10 firms' websites, they'll say they do comprehensive financial planning. It all looks
sea of sameness.
So if you start and then see the sameness, like you can't differentiate. You can't, and you don't necessarily. I say this a lot, and I believe this. Look, I think the good firms that are out there, like everybody's good. Like, are you going to be better? Like, you don't need to be better. If you're at that level where you're good, like you don't need to be better than everybody else. You need to be different. And it's not necessarily different in what or how you do it, but how you articulate it. And to go back to the close piece, if your close rate is, let's say you get, 100 meetings a year and you close 20 of them and you get 20 new clients, and that's just being broad, versus, maybe you focus on a niche, and that niche, you only get 50 meetings a year. So you're getting half the meetings. but your close rate is 80%. Well, now you just got, you got 40.
Yeah.
You got 40 clients, just doubled. Right?
I'd even take it beyond sales and into the service side and like looking at the financials, like you can set your organization up to serve a certain type of people.
Right.
There's a lot of service creep, right? Retirement consulting, there's a lot of service creep.
Yep.
Wealth management, there's a lot of service creep. And if you're serving 50 different types of clients, the chances are if you sit in a room with your, the other executives at your firm or the other advisors at your firm and you say, where do we expand? What do we add? What's going to benefit our clients? You're not really going to be able to figure that out because you don't have it's not like you're saying, hey, I only work with 55 to 57-year-old cardiologists, right? You're finding a set of companies or individuals that have similar needs,
right?
Similar sets of needs, and maybe a similar way of looking at the world. And then you're able to serve them better.
Right.
And you're going to get less fee pushback and you're going to be able, your organization is just going to be able to scale a little bit faster. And then you're going to bring it back to sales. You're going to be able to apply that knowledge and figure out where you get those 50 good meetings instead of 100,
right.
Mixed bag.
Yeah. Well, and it's a good chance that now you're starting to deliver value to that group. And guess what? Yep. We talked before we started about referrals. Like most advisors go in and if they do ask referrals from clients, they say, hey, do you know anybody? And most people are not wired in a way where they're going to be able to answer and say, oh, yeah, as a matter of fact, I know these 3 people. But if you can go in to a client and say, hey, I see you're connected on LinkedIn with these 2 people, they're CFOs just like you of like 2 companies in your industry. Do you know them? Yep. Like, niches, you just become much more referable if you work with a niche and you've got a value proposition that's easy to articulate. The other thing I think what you said is good, like that kind of services and scope creep. I think I've heard Jeff Bezos talk about it. I've heard Steve Jobs talk about it. Like what you have to get.
Can I take one step back?
Yeah.
I believe you just put me in the same category as Jeff Bezos and Steve Jobs.
You're welcome. You're welcome.
Thank you.
You're welcome. I like people to feel encouraged and uplifted and honored when they're guests.
I'm going to walk out of this feeling great.
But it really comes down to really be successful, you have to get really good at saying no. It's hard to be successful. It's hard to grow scale if you say yes to everything. And I think a lot of advisors are wired in a way that they want to say yes, or they feel like they have to say yes. But there's a lot of power in going back to kind of that niche of knowing what you do and delivering value to people who, know what their sets of needs are. Now you can start to say no to other things that may not be a great fit or may require a lot of investment or energy or time for you to do something different.
Yep.
That's going to derail the leverage you have in the area you're focused on.
I point to, again, another exercise we do when we're doing, because we do a lot of different types of consulting, and yes, a lot of them are related to perpetuation, internal perpetuation, external, whatever, valuation. But on the operational side, looking at the client books is one of the first things you do when you're trying to figure out how to grow a firm. You're looking at who's producing the business, but you're also looking at what kind of business is coming out. And it's that Pareto principle. Right. I think anyone that's listening to this that manages a book or has built a book of business or has built any business, doesn't have to be a book of business in the advisory world. Like, there's the 80-20 rule on your clients. Right. And you're going to have the top 20% producing 80% of the fees. And so you can go through the exercise and carve it off. But in the sense of this conversation, what you're kind of recognizing is, wait a second, I can have a very profitable business that might actually be slightly easier to run and easier to scale if I'm focusing on the type of clients that I like to work with or my firm likes to work with, the type of clients that I am set up to work with, and the type of clients that I now know how to find because I know where all my people hang out, whether that's a country club or, local pool or, wherever it is, like where they hang out. I know how to get there, even in the digital sphere. So,
and that's where you get leverage.
Right. Right, exactly. It's like, do you want to serve 150 clients, or you just want to serve 100 of the right clients? And you could make the argument that you could be pretty close in revenue at the end of the day, because you might even be able to charge a premium for what you do for your right clients, because you're only focusing on them, and you're able to wrap them with the services they need.
What are some of the drivers? You talk about valuation. You said something earlier, like,
Sure.
or multiples. It's kind of like, like what multiple are you measuring? Like if your advice, just give a little free advice as we're kind of wrapping up here a little, if you would, is like, if you're talking to, that founder, owner, partnership group of that small firm or whatnot, like, what are your top maybe 2 or 3 or 4 recommendations around, like, what are the real drivers of value and what should they be intentional about focusing on?
Yeah. So it's, let me bring it back and give, like, it is still a very active M&A market. 24, the first quarter of 24 was the equivalent of 2022 in deals. So it is as active as it's ever been. And then the first week of April was like 15 deals. So it's very hot. The multiples, I would say, I'm not going to say they've peaked, because peak kind of indicates that they're falling. They've plateaued. And I think your question is the question that everyone should be asking themselves is, like, what's driving those premium valuations, the greatest enterprise value? And it's a combination of things, but you can never get around scale, right? You could be the best advisor, the nicest guy, have 2 of the nicest people and have a $250,000 practice. That's great. Like, continue to grow it. You're never going to be as valuable as a $25 million business. So you can't get away from scale, whether that's assets or actual revenue. That is absolutely what makes you attractive, no question. And it changes how you're looked at, because acquirers, they've kind of got a couple different ways to look. You could be either a platform, like an enterprise platform, something that capital could invest in and then add things to it, where all those additional firms that they buy become more efficient because they're now plugged to you. You have to be pretty large for that, and you have to have a good team. And that's where you hear you back the rider, more than the horse at that point. So it's big on management, but you've got to get to a significant, call it 10 million plus of free cash flow of EBITDA to even start to be considered for that. You could be a regional hub, right? Acquirers look at it. We'll use the baseball analogy, and it's probably overused, but it's like a baseball roster where they're going to look at we need a starting first baseman, we need a starting second baseman, we need a starting third baseman, but that's more geographical, right? So we need a firm that can really carry the load of a region, geographical region. And then you have tuck-ins, and that's really anyone that's not quite big enough to handle, running a region, but would fit really well into, someone else's tech stack or management or whatever. So scale is number one. That's going to where you're going to create the greatest multiple lift, right? Then beyond that, it's going to be about profitability, right? Are you running a profitable business? And this is where I would counsel anyone. A business that is profitable, but able to continue growing. So not underinvested. If you see a 70% profit margin business, you probably realize it's a little bit underinvested if you're trying to look at it as a true business. The cash flow is great, probably doesn't have the greatest enterprise value. So profitability, then it's human capital, right? And then it's clientele, right? What do your clients look like? How long have you had them? In wealth management space, how old are they?
I would imagine younger clients, even if they have less in assets, because they have more.
I'd say it's a mix. It's not necessarily as black and white. I think different organizations would value them differently.
That's an interesting point. So part of this is also based on the acquirer's kind of philosophy or methodology or what they're looking for, it's not like a black and white. They might value a certain firm much more highly for maybe strategic reasons than another acquirer.
Exactly. Yeah, it's the reason. So when we run a deal process, and we don't do auctions. So yeah, there's 60, 70 acquirers out there. If we represent a firm, those 60 or 70 firms are not going to get to see that. It's going to be a very small tailored group that we work with our client on based on what we know, based on their preferences, so on and so forth. But even still, when you're seeing 4 or 5 or 7 LOIs, you'll typically find that, the majority of them kind of come within we call it a turn or two, right? At one times EBITDA or so on either side of like, a pretty narrow range. And then you'll find.
So to understand that, let's just say for round numbers,
sure.
If it was a 5 times EBITDA multiple, you'll see kind of a range of maybe like 4 to 6.
Yeah, I'd say this is what I would say. If you have 5 to 7 deals, and we'll just use simple math. I'm not trying not to go high or low just to not piss off my compliance team. But you would say, look, if we have 7 LOIs, you'll see, call them 4 or 5 of them are going to come right down the middle. They're going to be somewhere around like 10 or 10 and a half. But then you'll see like the beauty in the eye of the beholder effect, where you have an outlier or 2 outliers that just, they love the people, or they love the client base, or they need the geography, or it's these things that we try and track. Like we track where everyone has presence. We track where, how many clients they have in an area. We track where they're the Fidelity and the Schwab branches, so that, to see where they need, someone to actually be there to handle referrals. And that's where you see these outsized deals. So you really you can kind of predict, but you can never quite predict the value of your firm within an acquirer's business. The only way you see it is in those deal processes. But it goes to answer the question of like, it's never really a perfect black and white.
Right.
There's shades of gray, and it's because every acquirer is also looking for something different.
Right.
So,
and that's part of the value I would imagine that you guys have as well in working with them.
I think so. I think so. I mean, deals can be kind of complicated. It's part, it's part project managing, like a lot of different interconnected pieces. It's part quality of earning, at least the way we do things. It's a lot of quality of earnings up front. The last thing you want is surprises when you're at the end of your deal and having a deal get what we would call retraded or just blown up after you've spent 6 months of time on it. That's the worst for an owner.
Does that happen regularly?
Not with us. No, I can say very few, that happens very, very little with us. I can't say it happens. I couldn't tell you like statistically what it looks like, but I can say that from experience, if the financials are not handled right and the expectations are not set both upfront and with the acquiring firm as part of a pro forma exercise, that SIM, you'll see things get retraded at the end in a way that's typically not favorable to the seller, because they'll say, wait a second, it's like the skeleton in the closet thing,
Right.
It's like, what do you mean? Of course we're not giving you the same deal. Like, I found out that you murdered a guy. It's like, so
right.
So it's kind of part of our job is doing that up front, doing that Q of E, quality of earnings, kind of diligence up front, so we get ahead of everything, and there's no surprises at the end.
Right.
And there's the leverage factor too, but we're not on here to go through the virtues of using a banker or a broker or not.
Right. Well, I've loved your insights today. I mean, every time I talk to you, I feel like I learned.
I enjoy talking to you too. It's always a pleasure.
Well, where could people go to learn more, stay connected with you, learn more about Marshberry?
Sure. I mean, they can always go to our our Marshberry website. I mean, we do. If you're looking to be a part of a CEO, peer group, obviously we've got a couple segments open. We've got a $1 billion to $4 billion segment. We've got a $4 billion to $10 billion segment, and 500 to $1 billion. So if you're looking to be a part of peer group, reach out to me, and then I'll have our team send you an application, because it is a by invitation only. We try and get a lot of content out and just keeping folks informed, but you can always reach out to me or one of my colleagues. We're always happy to chat and share what we've learned. Like we were talking, Josh, the world doesn't always have to be perfectly commercial.
Right.
And it seems like serves us both fairly well so far. At least we're both kind of happy.
Right. Yeah, you don't have to charge for every single thing.
Yeah, exactly.
You do,
exactly.
And
you don't have to put a quarter in the machine to have someone pick up a phone.
Awesome. Well,
Yep.
This has been fun. We'll make sure in the show notes that we put kind of your LinkedIn and Marshberry's website, and I would say a plug. Not that I was part of a Marshberry CEO peer group, but being in one now, and then when I at Greenspring, I was in a couple of different study groups around the country, and there's a ton of value there. Just in, it can be as a founder of a firm, like it can be really lonely. And just when you're in kind of one of those peer advisory groups, and, obviously there's kind of rules of engagement and whatnot. And I would imagine the way you guys put those together is you might not be putting people who are like direct competitors in the same city in the same group, but there's some great relationships, great ideas that can come from that if you get the right mix in there of firms that are, recognize that it's not a zero-sum game, that it's more of a positive-sum game, and are willing to be very kind of transparent and open and share successes and failures and what they're doing that's working and maybe not working. I mean, it was hugely valuable. My co-founder and I both were in different groups, and we brought back a ton of great ideas and actually contributed a lot too in terms of things we'd done. But highly recommend that, and reach out to Rob, and if you can get in potentially one of those groups, you'll get a lot out of it.
And even if it's not with us, I completely agree. There's something, the way we run ours is we're more or less just kind of professional proctors, as opposed to, hey, it's not like a commercial or a conference where we're getting up, and it's really about just putting great people in the room and directing the conversation so that everyone's willing to, is that you got to have something to give and something to gain.
Right.
If those groups are successful. And I agree. I mean, there's a lot of knowledge gain when you put smart people together.
Yeah.
So
that and most smart, successful people I've found are like willing to share.
Well, it's about execution, right?
Yeah.
Sorry, we could probably have
a whole different
podcast tangent about that one.
People used to ask me, they're like, you write book, and I'm going to get killed by probably Will Hackler on this one because I'm bringing up the book, but I just say
I have your book.
I used to.
I have your book.
The question is, have you read it? Probably not. But
I actually did read it.
Did you really? Okay.
Read it. Yeah,
all
I did.
And you still admit that you had it.
I keep it. Look, I have a lot of trouble sleeping. And so I keep it right beside my bed.
It's the best cure for insomnia.
Give me like 2 or 3 pages, and I'm out.
You're done. It's perfect. That's perfect for that. It actually gets prescribed for that.
It's all natural NyQuil.
But my point being is, people would always say, like, why are you like giving your playbook to people? And kind of my point was, look, number one, like my playbook is kind of a collection of, there's some stuff I've come up with and there's other stuff I've curated from other folks. Number two, if somebody gets something out of it and it benefits them and their clients, like that makes me happy. That's great. But what I know is that 95% of people, like I can give them the playbook, like they're not going to execute on it. So like, why do I care?
I agree. Well, okay, let's tie this off with the bow then.
Okay.
The number of clients I have that say they're one of the greatest drivers of business for them is going on, television and talking about investments, or doing some sort of digital marketing, or speaking at an event. Like they're kind of telling you how they do things and what they do, and people are attracted to that. The people that are attracted to that are the ones you want to work with. So,
right.
There's my bow.
Love it.
Share.
Love it.
Be a sharer. Be a giver.
I always used to say, like, even one of our core values up on our website right now is, be a net giver, not a net taker. I always found that, like, if you're a net giver, you wind up getting the take, you get a lot out of it. If you're a net taker, it winds up not being that great because, you're in it for yourself. So great conversation, Rob. Thank you so much. Thanks for coming on. Glad we could get this done. Always great to talk to you and get your insights.
For sure. Talk to you soon.